Most people grow up believing a simple story about money. The story sounds reasonable. You work hard to earn money. You save some of it, and banks keep that money safe while helping the economy grow by lending it to others. In T's story, banks are careful guardians of your deposits, and money is something stable and scarce that must be earned through effort. But behind the polished image of marble bank buildings and reassuring financial language lies a system that works very differently from what most people imagine. The truth is far more uncomfortable. Banks create money out of nothing, and the cost of that creation quietly spreads throughout the economy, landing on the shoulders of ordinary people. To understand how this works, you first have to let go of the idea that banks simply move money around. Most people picture banks as vaults. You deposit your money, the bank holds it, and then lends a portion of it to someone else. But modern banking doesn't operate like a warehouse storing physical cash. Instead, banks operate more like money factories. When a bank approves a loan, it doesn't take someone else's deposited money and pass it along. Instead, it simply creates new money digitally by typing numbers into an account. This might sound unbelievable at first, but it is how modern banking systems function around the world. When someone takes out a loan for a house, a car, or a business, the bank doesn't hand over existing money that was sitting in a vault. It creates a new deposit in the borrower's account. That deposit becomes spendable money in the economy. From that moment forward, the money exists, even though it didn't exist before the loan was approved. Think about what that means for a moment. Every time a bank issues a loan, it effectively expands the total money supply. The borrower receives brand new money that was never previously earned or saved by anyone. This new money flows into the economy as the borrower spends it on a house, a car, construction, or business expenses. Sellers receive the money and deposit it into their own banks, and the cycle continues. In simple terms, banks don't just lend money, they create Italiano. This ability gives banks enormous power over the economy. The more loans they issue, the more money exists in circulation. When banks are confident and eager to lend, money expands rapidly. When banks become cautious and pull back on lending, money creation slows down or even contracts. Entire economic booms and recessions can grow out of this cycle. But the real question isn't just how banks create money. The deeper question is who benefits from this system and who pays the price. At first glance, the system seems harmless. After all, loans help people buy homes, start businesses, and invest in the future. Credit can fuel economic growth. But hidden inside every loan is a mechanism that quietly redistributes wealth over time. When banks create money through lending, they don't simply create the amount borrowed. They expect repayment with interest. That interest is not created at the same time as the loan. Only the principal amount enters the economy. The extra money required to pay the interest must come from the existing money supply, meaning someone else, somewhere, must earn it and transfer it to the bank. Over time, this creates a steady flow of wealth toward financial institutions. Imagine a simplified world where a bank creates $100,000 as a mortgage loan. That money didn't exist before the loan. The borrower uses it to buy a house, and the seller deposits the money in their bank account. But the borrower doesn't repay $100,000. They repay $100,000 plus interest, which could bring the total repayment to $180,000 or more over the life of the loan. The extra $80,000 wasn't created when the loan was issued. It must be earned somewhere in the economy and transferred back to the bank. Multiply this process across millions of mortgages, car loans, credit cards, and business loans, and you begin to see how enormous the financial flow becomes. This is one of the reasons the financial sector grows so powerful over time. The system is designed so that money flows toward those who create credit. But the story doesn't end there. Money creation through banking has another hidden consequence. Inflation. When banks create new money through lending, the total amount of money in circulation increases. If the amount of goods and services in the economy doesn't grow at the same pace, prices begin to rise. This is one of the fundamental drivers of inflation. Most people experience inflation as a mysterious force that quietly erodes their purchasing power. Groceries get more expensive. Rent rises. Houses become harder to afford. Salaries struggle to keep up. The official explanations often blame supply chains, energy prices, or global events. And while those factors do play a role, the expansion of the money supply is a powerful underlying force. When more money chases the same amount of goods, prices tend to rise. The painful irony is that the people who suffer the most from inflation are usually the ones who receive the new money last. When banks create new money through loans, that money enters the economy through borrowers, often businesses, investors, and asset buyers. They spend the money first, purchasing assets, property, and investments before prices adjust. By the time the effects ripple through the economy, prices for housing, food, and everyday goods begin to rise. Ordinary workers experience the price increases before their wages catch up. In other words, the purchasing power of their savings slowly declines. This process is sometimes called the hidden tax of inflation. It doesn't appear on a tax form, and no government invoice arrives in the mail. But its effects are real. The money sitting in a savings account slowly buys less and less over time. For people living paycheck to paycheck, this erosion can be devastating. Rent climbs, groceries become more expensive, fuel costs rise. Yet wages often adjust slowly, if they adjust at all. Meanwhile, those who own assets, real estate, stocks, and businesses often benefit from the same inflation that harms savers. Asset prices rise as new money flows into the financial system. This creates a powerful divide in society. People who own assets tend to grow wealthier as the money supply expands. People who rely mainly on wages and savings struggle to keep up with rising costs. In this way, the system quietly amplifies inequality. Another consequence of bank-created money is the culture of debt that surrounds modern life. Because most money enters the economy through loans, debt becomes woven into the fabric of everyday existence. Homes are bought with mortgages, cars are financed, education is funded through student loans, businesses expand through credit lines. Debt becomes normal, almost unavoidable. But debt carries a psychological weight as well as a financial one. When people owe money, their future income is already partially spoken for. Monthly payments become obligations that shape life decisions. People stay in jobs they dislike because they must cover mortgage payments. Entrepreneurs hesitate to take risks because they carry existing debt burdens. Debt becomes a form of economic gravity, pulling people into predictable patterns of work and consumption. At the same time, banks profit from this structure. Interest payments generate steady revenue streams that can last decades. A 30-year mortgage can produce tens or even hundreds of thousands of dollars in interest. And remember, the money being repaid with interest originally came into existence when the bank created it digitally. This realization can feel unsettling. The system that governs modern money isn't based on the simple exchange of earned value. Instead, it is built on layers of credit creation that expand the money supply while generating long-term obligations. Critics of the system often point out that this structure encourages cycles of boom and bust. When credit expands rapidly, the economy heats up. Asset prices rise, optimism spreads, businesses borrow to expand, and consumers borrow to spend. But eventually, debt levels become too heavy. Borrowers struggle to keep up with payments. Banks become cautious about issuing new loans. Credit slows down, and the money supply stops expanding as quickly. This shift can trigger recessions. Businesses cut costs. Unemployment rises. Asset prices fall. Suddenly, the optimism of the boom years turns into anxiety and contraction. These cycles have repeated throughout modern economic history. Yet despite these recurring crises, the basic structure of the banking system remains largely unchanged. Banks continue to create money through lending, and society continues to rely on expanding credit to fuel growth. One reason this system persists is that it benefits powerful institutions. Financial companies generate enormous profits from interest payments, financial services, and asset management. Governments also benefit from a system that allows money to expand, because economic growth and rising asset values support tax revenues. At the same time, central banks often step in during financial crises to stabilize the system. They lower interest rates, provide emergency funding to banks, and sometimes create new money directly to support financial markets. To many observers, this creates a sense that the financial system has built-in safety nets for large institutions, while ordinary people bear the consequences of economic downturns. When banks face trouble, rescue programs appear. When individuals face foreclosure or bankruptcy, the support is far less generous. This perception fuels distrust in the financial system. People begin to feel that the rules are different depending on where you stand in the economic hierarchy. Yet the complexity of modern finance often hides the mechanisms behind technical language and economic jargon. Terms like liquidity, monetary policy, and credit expansion sound abstract and distant from everyday life. But the effects are anything but abstract. They show up in the price of housing, the cost of education, the interest rate on a credit card, and the purchasing power of a paycheck. Every time money is created through lending, the ripple effects spread through the entire economy. Understanding this system doesn't necessarily mean rejecting banks or credit entirely. Loans can play an important role in economic development. Businesses need capital to grow, and families often rely on mortgages to buy homes. But understanding how money is created can change the way people see the financial world around them. Instead of assuming money is fixed and scarce, you begin to see it as something dynamic, something constantly expanding and contracting based on credit creation. You start to notice how economic incentives shape behavior. Banks earn more when they lend more. Borrowers often feel encouraged to take on debt because credit is widely available, and governments sometimes rely on monetary expansion to manage economic challenges. This perspective also explains why housing prices in many countries have risen far faster than wages over the past several decades. As credit becomes easier to obtain, more money flows into real estate markets. Buyers can borrow larger amounts, which pushes property prices higher. The result is a housing market that increasingly favors those who already own property while creating barriers for first-time buyers. Over time, the gap between asset owners and non-owners grows wider. For younger generations entering the workforce, the system can feel particularly challenging. They face rising living costs, expensive housing, and the expectation that debt will play a major role in their financial lives. Student loans, mortgages, and credit cards become part of the normal financial landscape. Yet few people are ever taught how the money system actually works. Schools rarely explain that most money is created through bank lending. Financial education often focuses on budgeting and saving without addressing the deeper structure of the monetary system. As a result, many people navigate the financial world without fully understanding the forces shaping it. The goal of understanding these mechanisms isn't to create fear or conspiracy theories. The banking system is not secretly run by villains plotting in dark rooms. Instead, it evolved over centuries through policies, incentives, and institutional habits. But systems can produce outcomes that no individual intended. When banks create money through lending, the system naturally rewards those closest to the flow of credit. Financial institutions gain power, asset prices rise, and debt becomes a central feature of economic life. Meanwhile, inflation and interest payments quietly redistribute wealth over time. Recognizing this dynamic allows people to ask better questions about the economy. Why do housing prices rise so quickly? Why do financial crises repeat? Why does wealth concentrate in certain sectors? Many of the answers trace back to the mechanics of money creation. Once you see this pattern, everyday financial news starts to look different. Headlines about interest rate changes, bank lending, and monetary policy are no longer distant technical details. They become signals about how the money system is evolving. Interest rate increases can slow borrowing and cool inflation, but they also make existing debt more expensive. Rate cuts can stimulate borrowing and investment, but they may also inflate asset prices. Every policy choice involves trade. The challenge for society is finding a balance between economic growth, financial stability, and fairness. Too much credit expansion can fuel bubbles and inflation. Too little credit can slow investment and economic activity. Some economists argue for tighter regulation of banks. Others propose alternative monetary systems, including digital currencies issued by central banks or reforms to how credit is created. These debates continue around the world, but regardless of what reforms may come in the future, one fact remains central to understanding the modern economy. Banks play a critical role in creating the money that circulates through society. And every time that money is created, it comes with consequences. Borrowers gain access to purchasing power, banks earn interest, and the money supply expands. Prices shift, opportunities change, and wealth moves through the system in subtle ways. The price of this system is rarely paid in a single dramatic moment. Instead, it is spread across millions of transactions, small price increases, and decades of interest payments. It shows up in the rising cost of living, the pressure to keep earning more, and the constant presence of debt in modern life. Banks may create money with a few keystrokes on a computer, but the ripple effects of that creation shape the economic reality of billions of people. And in the end, while the system may appear complex and technical, its core dynamic is surprisingly simple. Banks create money, the economy absorbs it, and ordinary people, often without realizing it, pay the price over time.